Welcome to Bits of Wisdom, offering insights on money, Bitcoin, and the world of exponential change. Hello, and welcome to Bits of Wisdom, in episode 7 of our series on money, monetary policy, and Bitcoin. We're more than halfway through, and I'm glad you could be with me. I'm Paul Rogers, and in this episode, we're going to talk about the last two great crises, 08 and 09 financial crisis, the pandemic. We're going to look at the government and the Fed's response and the ramifications that we're seeing in the system. So let's talk about the financial crisis of 08 and 09. So most of us all lived through the very difficult period of 08 and 09, the unraveling of the global financial system. And the stories and the various versions of it have been told many times. Overvalued real estate, indebted owners, bad mortgage loans, Wall Street shenanigans of packaging bad loans in a nice wrapping paper, and all these junk loans, leveraged and swapped and turned into collateralized debt obligations, etc., etc., etc. The upshot: no more Lehman Brothers, Wachovia Bank gone, Merrill Lynch saved by Bank of America, and on and on. The financial system seizing up. This was not a normal business cycle economic recession, if there really even is such a thing inherent in an economy. This was a credit or debt financial crisis. And oh yeah, millions of people lost their jobs and their houses, everyday working folks tossed from their homes, lives ruined, and souls crushed. Now, I'm not going to go into all of the causes of this crisis. What's important to understand is how the government and the Fed responded. With the system seizing up, the government and the Fed stepped in with one thing: money. Now, as you darn well know, this wasn't money they had, because they sure as hell couldn't raise taxes in this environment to pay for a bank bailout. So they responded with what was becoming the primary tool: rebuilding the financial system by recapitalizing financial institutions. Okay, fancy word, recapitalizing. In short, they created and put money on the balance sheets of banks and other large financial institutions. Lots of nuanced ways that aren't important to get into, but the Fed pulled out its bag of tricks, dropped interest rates to zero to get money while really debt moving again. Now, I'm not saying this was the wrong thing to do. Presented with a situation largely of their own and our own creation, they had little choice compared to the even more horrific impacts of a total shutdown of our financial system. And slowly it worked, well, sort of. The economy did get moving again, but the Fed had to keep interest rates at near zero for years. And who did this hurt? Well, a lot of my former clients who were relying on income and interest from safe investments in bank savings or bonds. Think about this. If you had $200,000 in a bank at 5%, it generated $10,000 a year in safe, stable income. But at 0.05%, you walk away with a cool $100. Now that ain't going to pay the bills. Now, things settle down. But after all, if you reward yourself after an unhealthy meal with a fudge sundae, it tastes pretty good. And you forget the price you're going to have to pay eventually, especially if you keep it up, which is what happened full force in the pandemic. So we're no longer in history, we're talking about right now. So in March of 2020, COVID hit, and the response was to lock down and shutter the economy. Again, I'm not saying this is right or wrong, it's just what happened. So what's the policy response? Well, it worked last time, let's push all the chips in. So the government passed legislation to spend trillions of dollars, send checks to people, give money to small businesses, etc. And the Fed, well, it immediately took action, slashing interest rates that had ticked up a bit back to zero and flooded banks and the system with money. We heard Jay Powell say it very clearly in another episode. Money was falling from the sky like rain. Now, I'm not trying to say this was right or wrong. From where the bankers and the politicians sit, it makes perfect sense. But you and I all know sooner or later you have to pay the piper. So let's look at a chart of what's known as the money supply over the last several years. This is produced by the Fed, and it's a measure of money in the system. Notice a little uptick in the last 2 years? Notice a huge uptick? Again, there's lots of nuances to the system. I'm trying to simplify this, but it's undeniable that the government and the Fed's response to the pandemic problem was in essence to helicopter drop cash everywhere. Again, not necessarily a wrong response given the situation, but you need to understand what's happening. So where is the money coming from that allows the government to spend so much money? It sure isn't from tax dollars, it's from debt. Remember the cat in the hat, that great children's story? Mom was away for the day and the kids were left alone, and along came the cat in the hat. And chaos, which was fun for the kids, ensued, all of which resulted in that great line. This mess is so big and so deep and so tall, there is no way we can clean it up. No way at all. Sounds a lot like where we are right now. Now remember when we talked about the debasement of money, the Roman emperor's coin clipping, the U.S.'s revaluation of the dollar at 41% less after banning private ownership of gold, and the basic economic principle of how when you create more of something, its value goes down? Well, all of this is a factor that's leading to inflation. Again, there are many different sources, supply and demand issues, which I mentioned, all right, but there's also a monetary source. And inflation is now in everyone's mind and in their checkbook because we are seeing rapidly increasing prices. And what a surprise! While the Fed at one time said this inflation would be transitory, they're now thinking differently. And again, who's getting hurt? Everyone who has limited resources to buy gas, food, or heaven forbid a house. Remember, that's how I got into this rabbit hole. So, this all brings us back to one of the definitions of what makes good money, a store of value. That's what it's supposed to be. Well, if the stated inflation rate, as measured by a very questionable calculation that goes into the Consumer Price Index, is now at 6.8%, that means my cash is declining at nearly 7%. You keep a buck in your pocket, and a year later you're going to pull out 93 cents worth of purchasing power. Hey, for a buck, not a big deal. But if you have $100,000 cash in the bank, that's $6,800 lost. Well, it's offset by that 0.01% interest you're getting, but how many years can you keep doing that? And if you don't want to just buy the government's basket of goods and you want to buy a house, well, you're looking at cash vaporizing at the rate of 20 or 25%. Now, the dollar is still a good medium of exchange, perhaps the best in the world. It's a good unit of account, but as a store of value, as a way of savings, it's getting a little questionable lately. Do you hear the piper playing? Listen to the tune for what it is, and don't just blindly follow him or anybody. All of which is what brings us to Bitcoin, and that's what we'll get into in the next episode. So again, I'm Paul Rogers. I haven't said it anywhere else, but if you're enjoying this series and watching it on YouTube, please hit the like button and subscribe to this channel. Thanks again. We'll see you next episode.